This is an overview of the homework for percent of accounts receivable versus aging versus percent of sales. So let's kind of walk through this together. A, okay, is estimating the allowance, assuming the company uses 6% of total accounts receivable to estimate uncollectibles instead of the aging method. So when they do that, now look, it's very important, total accounts receivable. So that's just not annual accounts receivable. But that is the total accounts receivable. So your bad debts, okay, over here, will be adjusted. And the number that you get from that 6%, that 6% number equals the balance required in the allowance account. Does that help? So that means if you have an allowance or have a balance in the allowance account already, the number you get for that 6% is going to be the ending balance, and your adjustment is how to, that you use, it becomes the bad debts in here. Now what we're doing with this, though, is I want you to compare the 6% that you get here with the actual, if you age it, if you use the analysis. So we're going to use these numbers here to create the number that you would have in the balance if you use the aging. How close are those two? I wanted you to see the difference in the amounts of the bad debts on this one. So it may be a little bit confusing. This is A, which is the percent. This is B, which is using the aging. And both of them are using the entire amount of accounts receivable, so the bad debts will be the adjustment between the beginning balance and the ending balance of the allowance account. Okay, so if you go to percent of sales, now we are looking at a different, is it annual sales that they're asking for? Credit sales of $915 and cash sales of $315. Let's try that again. Cash sales of $915 and credit sales of $315. The year-end unadjusted balance for the following items is that accounts receivable has $140,000 and the allowance account has $6,500. And that must be a debit balance. And they want you to prepare the adjusting entries to record the bad debts, assuming that they are estimated by credit sales, percent of total sales, and percent of just the year-end accounts receivable. That's an interesting Now, as I said, it's an interesting combination. The first two, the 6% and the 4%, are on annual sales. So the calculation you get is going to be the bad debts. No adjustment. So that's just going to be straight out and out bad debts. But on the 9%, okay, on the 9%, they're saying the year-end accounts receivable, which means the entire accounts receivable, okay, from previous years, is at 9%. That, okay, is the entire AR. That calculation is going to give you the balance required for the allowance, which means what? Okay, it's going to start with a debit balance. The calculation is going to be the balance, calculated balance, right? So the bad debts is going to be in the adjustment to that account. Can you remember that? The very last one, okay, is the entire AR. And the balance, its calculation is going to be the balance required for the allowance. So I hope that helps.